Good morning. I'm Quincy Enoch, the co-chair of the Tax and Financial Services Practice Group at Invariant, a government relations and public affairs firm. I want to thank you for joining us today for a discussion about the crypto reporting provisions included in the Infrastructure Investment and Jobs Act, the bipartisan infrastructure bill. Today, I'm joined by Erin Fennimore from TaxBit and Rob Massey from Deloitte Tax, and we will dive into exactly what these new requirements are and what these new requirements mean for the companies that will be subject to them and the crypto industry overall. Erin and Rob, thank you for joining us today, and I look forward to the insights you will provide us. When the crypto reporting requirement first came to light last summer, it somewhat rocked the industry because it was the first time where we saw a situation in which government and the regulatory environment was being changed in what seemed to be a very significant way. During that time, there was kind of a narrative that was built in that it essentially said that there was a new tax on crypto. And that's not quite right. So, Erin, I'd like to start with you and just see if you can explain the tax treatment of crypto before the provision.
Oh, for sure. Thanks, Quincy. Very excited to be here today. So this is a bit of a confusion because we're looking at, crypto, quote unquote, taxation from two different vantage points. First, you have the vantage point of the individual taxpayer. Crypto and the related, capital gains or income, depending on your trading activity, that was always subject to personal taxation. But then you look at it from the other side of if I'm the entity, if I'm the cryptocurrency exchange facilitating that trading and making those payments, well, what's new for me? And prior to the infrastructure bill, I think there's a bit of a split in the industry of what was formerly required. Was this always included under 6045, which is the regulations that really focus on broker reporting requirements? And I think that's where the kind of split comes into play here of did this infrastructure bill really change everything with respect to information reporting? I think some would say no. I think some would say that it always existed, but then obviously others don't take that position. And really what that highlights is the need to clarify this within those 6045 regulations, which is hopefully what is coming very soon from the IRS.
Now, that's great. Rob, can you, expound on that and, just go into a little bit more in terms of now that these provisions are law, what is it going to mean? What does it mean that we have in terms of tax treatment? What's the impact here?
Yeah, absolutely. And I think to Erin's point, the treatment to an individual who exchanges digital assets, you exchange them for fiat or exchange them for one another. The tax treatment of that has been fairly well understood. While we don't have anything super explicit in the code, it was fairly well understood in industry practice. When we exchange one digital asset for another, that's a taxable transaction in the US and in many parts of the world. And to Erin's point, that's always been there. And in the US, we have a self-reporting system. And so you need to put that on your tax return as it is. In traditional exchanges of securities and commodities, it's common that you do that through a broker and that you receive statements on a Form 1099 when you do exchange traditional commodities and securities traditionally. There's been confusion, I think, for over a decade now as to whether or not the traditional rules of 6045 and the broker reporting requirements do apply to exchanges, those who facilitate transfers of digital assets. And there's been really good historical arguments on both sides of that. What this provision does is it clarifies what are the responsibilities of a broker. It redefines broker, right? And I'll read to you explicitly. It expands the definition of broker in 6045 to include any person who, for consideration, and this is important, for consideration, is responsible for providing any service that actually facilitates the transfer of digital assets on behalf of another person. So it expands the definition of broker to explicitly include those. It's pretty broad, those who affect transfers. But importantly, and this is what people miss, it defines digital assets. Oh my gosh, this is a big deal. So for the first time, right, we've lived with Bitcoin for over 13 years now. For the first time, we have a definition of digital assets in the Internal Revenue Code. Big deal. Okay, this is a big deal. The important significance is it's very broad. Okay, and it's a codified definition, so intentionally written broad, and then the Treasury regulations will clarify over time. But it's written such that any digital representation of value, which is recorded on a cryptographically secured distributed ledger, right, going well beyond blockchain, right, but DLT, or any similar technology as specified by the Secretary. Again, giving Treasury room to clarify it later.
Great. Rob, let me ask you this, because definitely want to get into a little bit more about the discussion of the definition of broker, because I think that is something that is on everybody's mind right now, and certainly sent the crypto industry kind of into this state of complete and total uncertainty about what that's going to mean. And so we'll talk about that a little bit more, but I was hoping you could, break down a little bit the provisions, as they are, so that we can all, have a good understanding for what exactly are we dealing with, with these provisions.
Absolutely. So we define broker, we got that. We define digital assets. We talked about them being a specified security that brings online basis reporting, which is really going to be hard in this space. We'll talk about readiness probably later. It talks about the required transfers of digital assets, not just between brokers, reporting of transfer between brokers, but also those that come from non-brokers or go to non-brokers. So if you're hooking up with your MetaMask wallet and you come in to a broker, then those kinds of things are captured. So all the transfers therein. Businesses accepting crypto or anyone accepting crypto over $10,000. This is a throwback to the days when you walked into a bank with $10,000 in cash and they had to put it on a form. We now have that with crypto, and that is required as well. The effective date is transactions on or after Jan 1, 23 as it currently stands. So we'll start to see that in the first reporting year 23, which is in the beginning of 24 when the forms will come out. And importantly, the rule of construction, it was really crafted in a way that says, hey, we're clarifying this now. We're not saying anything positive or negative about the past. We're just drawing a line in the sand for transactions on or after Jan 123. So this is a prospective looking clarification, but it leaves room if anybody wanted to go back, they probably could.
Now, I think that's great. And, one of the things that you touched on that I think sometimes gets lost in the discussion is the idea of reporting anything over $10,000 that you receive as a business. I think that's a very important provision that, kind of changes the game in a lot of respects. But Erin, I'd love to get your take on this, because this is one of those situations where I feel like there's, the code kind of says one thing in one place and one thing in the other. And I've had this debate with many people where in this instance, we're treating crypto as cash. But in other instances, we don't quite want to treat it, exactly as cash. And just wondering if you had any thoughts on that.
Yeah, this is the tricky part about looking at the situation in which crypto is being utilized for, right? For trading purposes, it's really being looked at as, property or a security. But then you have I go into a car dealership and I all of a sudden can use Bitcoin to buy a car. And in that scenario, I'm looking at treating cryptocurrency as cash. So again, we won't get everything handed to us on a silver platter. That's just not how it's going to happen, unfortunately. And there's going to be discrepancies throughout certain provisions. There's still going to be vagueness in certain provisions. That exists today with I think traditional broker reporting overall. Not everything can be a hard black and white rule. I think one of the things, especially with respect to the cash treatment scenario, is just a completely different mindset for that reporting. That Form 8300 is I don't know if archaic is the right word, but just a completely different concept for information reporting, because you're looking at the sender and receiver. So different information, much more information than a Form 1099. So I think particular to that cash treatment in that Form 8300, that's going to be an even harder hurdle to overcome if these crypto native or any company really that's accepting crypto as a form of payment will have to overcome.
Okay. No, I mean, I think that's absolutely right. And it's just funny because, like I said, in these debates, even kind of in the policy debates, I think that's one of the things that gets lost a little bit because everybody's focused on the reporting and, certainly that's important and will have a major impact. But I always like to make sure that we don't get lost on reporting of that, $10,000, equivalent, because that's a big one. One of the things I've seen, and I think a lot of folks that might be skeptical about cryptocurrencies and what impact it could have on our financial system and things like that, a lot of times point to tax evasion. And so, people are, moving their money around in crypto, they're evading taxes. There hasn't necessarily been this reporting in the past. So, some people claim there's, been a lot of tax evasion in terms of not paying your taxes on your transactions or even hiding money in crypto so that folks can't find it. And so, want to get your take, Erin, and we'll stick with you, and then Rob, I definitely want to get your take on it, how this provision can be a tool to help, close that tax gap and ensure that there's not tax evasion. Because I know in the crypto world, we're trying to find a way to create solutions for everybody that has concerns, and this seems like this might be one.
Yeah, I think to answer that, taking a step back of the overall purpose of information reporting is going to highlight the need for information reporting and explain it better. Tax evasion, is it specific to crypto? Is it only there? Of course not. And that's already, kind of an issue out there that is known. The whole foundation of what information reporting can provide is facilitating and ensuring that there is that self-reporting happening on the individual, taxpayer side. If you have that gap, which we have right now, it just opens up that possibility further. If you don't have an alignment between income tax reporting and information reporting, well, then, of course, that possibility is out there. And that's really, I think, overall the point of having information reporting, because it helps facilitate and close that gap.
Rob, love to hear your take on that.
Yeah, I mean, 100%. I actually think that there's as many or more people that have asked for this type of clarity more than don't want it. And that is because, under exam, right, it's fairly transparent because the agent's going to say, hey, show me your addresses. And they're going to look at the inputs and outputs of those addresses. And they're going to say, show me the transactional activity there. And we're used to a level of support coming from those who facilitate digital asset transactions. And so now, instead of the burden coming to the taxpayer to prove what are your transactions and tell me what those all represent, now you can say, gosh, when I transfer to that address, that's not actually a transaction. I put that with a custodian. Right. So that's not a taxable transaction. You can see that now. And then that custodian, who's then affecting transactions commonly, they're gonna have tighter reporting to say what were those transaction types. So that burden is not placed on the taxpayer. I mean, to your point about evasion, I know this is discussed a lot, but there's actually more transparency around digital asset transactions than there is around fiat-based transactions and greenback. So I actually think that a lot of the federal agencies like crypto because it's easier to see what's going on. And I think it's fairly common who those are in this space. They want to do the right thing. They want to put it on the form because they know that it's out there forever, right? You can't get around it. So it's a net positive thing that this clarity is being made.
I would certainly agree with you. Kind of want to take the conversation back to that broker definition that you touched on a little bit earlier, Rob, because I think, in the crypto industry, this is, one of the top issues, top concerns. It's what's keeping people up at night, right? I think that the reaction to the language that was in the bipartisan infrastructure bill was that it seemed that, if my brother bought crypto, then I was a broker. That's how broad it seemed like that language was. And so people were concerned. But as you mentioned, there is language in there that allows the Treasury Secretary to issue regulations, kind of defining that a little bit more. And so, Rob, let's stay with you for a minute and just see, with that broad definition, you kind of, were able to kind of read off what the definition was for us earlier. How does that broad definition cause issues? How is it problematic for the crypto ecosystem as it stands, right now, without the benefit of some clarifying regulations?
Mm-hmm. Yeah, it's a good question, and we saw this play out. Actually, I think it was the Senate floor and something called colloquy, where there was very clear recommendations of members of Congress as to where this should or shouldn't apply for various reasons. And when Treasury does pick this up and write regulations, they'll for sure have knowledge of those preferences. We'll see what they do with it, but I think that there's a decent amount of respect for those wishes. So who it applies to first? So centralized exchanges, some would say CeFi, right? So those custodians facilitating digital asset transactions. There's a question about DeFi really, and how that's going to call into play, and whether or not there's really knowledge of the participants on the platform. So that's a big question. We have NFT platforms out there that come in different flavors, some which have greater knowledge than others about who they're facilitating transactions for, or those who are providing a software solution versus actually in the middle of a transaction. Those are the clarifications, hopefully, that'll be made in the regs, and that is, how much influence or control do you have on the transaction versus just providing software that facilitates them. Those are some of the debates playing out. You also see this in marketplaces, digital asset marketplaces. You see it in gaming platforms, and increasingly in metaverse and omniverse type platforms, where digital assets are very much a part of those transaction types. And so we'll see this play out again. I think most of us expect some clarity in the regs, but this will play out over time, just because, gosh, the business transactions continue to evolve. The forms of digital assets and products continue to evolve.
I think that's absolutely correct. And, Erin, I'd like to come to you and get your perspective in terms of, Rob said, things are going to evolve, things are going to change, right? I mean, I think if you were to go back to, the late 80s, early 90s and try to craft rules for the internet at that point, they would be pretty obsolete, right now, not being able to take into account all the innovation that would take place. And so I guess my question to you is, in terms of trying to get these clarifications from the Treasury Department, and they are expected to release, a regulation on this, is this something that's just going to have to continue to evolve? Is this something where, we're going to have clarity for right now? Or, do you think that you can kind of set a baseline where you just have to make some tweaks, as we move along and we see more innovations?
Yeah, that's a really good question. I think that the speed of innovation within the digital asset space is so fast paced that we will never have a one size fits all in terms of the legislation or clarity from, Treasury. It's just, I always think that when I started here at TaxBit, of course, NFTs were out there, but were they the hottest things out there in the market? Did I hear about them every day? No. 1 month later, they were. So, and I'm already hearing new products. And I think overall, we are going to have clarity for the clear-cut brokers, the centralized exchanges, even in the NFT marketplaces, the intricacy of how they operate internally with the path of payment and how the actual mechanics work, can vary company by company and completely change the tax outcome in terms of their information reporting and if they would fall into that broker definition. So I think we're going to get clarity for a large scope, but I think that the innovation and the various, kind of entities that are coming into this digital market space will continue to evolve, and we will have to evolve legislation and, regulations as that happens. There's never going to be a bright line rule for every single scenario.
I'd like to maybe comment on something you said. Like, what happens when we bring clarity to a topic that is inviting new commercial activities? This is really a good thing because it allows other people to enter who are worried about the risks of doing something wrong and a regulatory footfall. So when we see clarity made, you may not love how the clarity was made, but at least we have clarity. And it's clarity in a way that allows innovation to move forward. It allows businesses to facilitate transactions involving digital assets. So I think, there's a lot to celebrate when clarity is made, even if you don't love the way it plays out.
Yeah, I talk about some with our clients, the traditional financial marketplace, having the security of clarity, I think it facilitates their entry into this market.
For sure.
Yeah. I mean, I would certainly agree. And thank you both for those comments, because I think, that's one thing that, was weighing on folks' minds in terms of, what is it going to look like? Things are changing every day. I think, Erin, your point about how NFTs seem like overnight to be the new hot thing. And, tomorrow, a month from now, there'll be something else probably occupying that spot. Couldn't be truer. And so to that point, I think often what ends up happening when you're in the search of clarity is that you kind of have to balance having some clarity and certainty versus the innovation, right? Because if something's certain, then that means it can't change. Innovation is change. And so, with those ideas, there's there's some people that discuss with the way that the legislation was written in terms of the definition, that it was great that the Secretary of Treasury has the ability to write these regulations and kind of tailor it to how it fits. But the question that's hung out there and some people ask is, well, that's this Treasury Secretary. The next Treasury Secretary might see it different, and we might see kind of some of those definitions get upended. And so I'm wondering, love to hear from both of you on this, whether there needs to be a legislative fix. So when we see what Treasury comes out with, they come out with a rule. It's a perfect rule. We all love it. That's not always the case, but let's, for sake of argument, we love it. We think it's a great definition. Is that something that should be taken and put into statute? Or, is it better that it lives kind of in the regulatory realm so that there is a little bit more flexibility? And, do you guys see any current, similar issues in the financial system where you have something that, has some certainty and people believe in it and don't think it's going to change, but may not necessarily be in statute? Rob, why don't we start with you on that one?
Yeah, I mean, this cuts both ways, and I think there are instances where there's a very specific definition of security or commodity that it lives in the code, and then what happens is it is inflexible in allowing evolutionary commerce that includes things like digital assets, and then we're stuck with it in debate, and it creates risk, it creates uncertainty and ambiguity, and prevents people from entering transactions, and that's really hard. I'd say that the things that are codified less flexible than things that are subject to interpretation and revision by the Secretary of the Treasury. So having the flexibility, particularly now because we're still early days relatively with digital assets and crypto and broader blockchain applications. So having the flexibility there, given our early state, is probably a good thing, so that as clarifications continue to be further made, then they can make those over time. So should there be more clarity made in the code as far as who it applies to? Maybe, but then what happens if that clarity is so tight, and then we have an evolution into a new area, and then we have more vagueness or more ambiguity, or someone's actually harmed because they don't fit into something like a safe harbor? And I think that happens more often than not. It comes more often with definitions of a type of asset or a particular type of party and how it fits into a provision. And since we have an evolution in both, I think that we have to trust that our Secretary of the Treasury is paying attention to what's going on and trying to do the right thing, and take some comfort that it's not just small startup crypto natives anymore. It's big brand names. Some of the largest companies on the planet are engaged in digital assets with a point of view. And that means that our regulators are listening with a great deal of respect. It's not just the startups anymore, and they respected them, but it's very different when the big brand names show up.
Yeah, I would just echo everything that Rob is saying, and overall, this industry is not static. It is moving extremely fast. And having that clarity from a regulatory standpoint of what are my obligations if I enter this industry, and closing that gap with respect to what is my customer or account holder also responsible for, that is giving security to different companies, big brand names coming into this industry. But the flip side of the having really clear regulation is also, can it keep up and accommodate with the future innovation? And so it's a dance that we're playing, of interpretation, and also having regulations that are dynamic enough that they can flex with the industry. And that's, I think, extremely challenging.
Yeah, there's another dynamic that has played out in our history whereby there was broad levels of interpretation allowed by Treasury, and then Congress didn't like where the direction that the interpretation was taking. This actually comes around with securities lending, which is again a topic with crypto. Congress came back in later and codified in 1058 some safe harbors because they felt it was appropriate given the industry, given what Wall Street was doing. So again, when we think about big brand names coming into play and expressing a point of view, and then as the broader regulatory body saying, look, we need to protect commercial activities. I think, Quincy, what you were saying is, hey, if there's a point of view in Treasury that's sort of harmful, if Congress disagrees, they can come back in, right? It's not like it's dead and gone and forever. It can come back and say, actually, what we meant was this. So it's not like a forever closed door. Trust the regulators.
No, I think that's I think that's right. I think that's right. I think you definitely need a little bit of a balance with regard to certainty and the flexibility needed to kind of keep up with the marketplace. So we'll see how it works out. We'll see when these regs come out. We'll see, if there's a push. There's been, a number of pieces of legislation that have been introduced to try to address, the broker definition. And I think a lot of that, seems to have taken what I think is a good approach, where they really are trying to take people out of the equation versus define who's in the equation, where it's clear to see that there's some parties that they're just not the people that are sending out 1099s. And so it does seem like that's been kind of the approach, and it seems like a better approach. But one thing that, I think, Rob, you actually brought it up a little bit earlier in terms of decentralized exchanges. I think there's a really big question there when it comes to the reporting and what's going to happen. Now, the more I learn about decentralized exchanges, the more I realize there actually aren't that many decentralized exchanges. There's a lot of exchanges that say they're decentralized, but may not quite be as decentralized as they appear. So it might not be an issue for them, but for those that really are just protocols, and there really is kind of no central thing that's there. How do they get treated under this new broker definition? And then just to layer another little bit of complexity on top of that, I know the SEC is taking a look at the ATS rule right now, where it would seem that a lot of these decentralized exchanges, the question might be answered because they're going to have to register as exchanges. Love to hear you all's take on that. And it just seems like I'm not going to get a clear here's exactly the answer, but definitely want to know what the thoughts are.
Yeah, it's a good question, and clearly a trend that we're seeing. And we tend to put types of businesses and protocols into buckets, but the fact is they are so different in the way that they're designed and the way that they're enabled. This is going to take some time to play out. I don't think we expect a ton of clarity in the first round of regulations, just because I think they want to get the baseline stuff set first with CFI. I think that's what we predict, but who knows? There is a question of jurisdiction, I think, which you referenced first. I don't know that necessarily what the SEC does dictates what the IRS does or Treasury does here, but clearly if you have to register, then that says something. I think when you reference protocols, And the other common example is, miners or validators. How does that come into play? I think there was some thought in the way that it was constructed. Are you doing it for consideration? And that really is helpful in trying to draw a line directionally. If you're just software that is being used by others in peer-to-peer transactions, right? Directionally, that's where that's going. Like, hey, you shouldn't be then required probably to produce 1099s, but who knows? I think that's the way it was written intentionally. The bigger question that we hear, gosh, I am sort of in the middle of the transaction, but I don't know who these people are. That's a different scenario that is going to be really hard for Treasury to wrestle with. But I mean, Erin, your perspective on this, because I know you're the ones in the hot seat trying to design software to enable people to be compliant.
Yeah, I would say that's right now there's kind of this idea of there's CeFi and there's DeFi, and that's not really just the two buckets. CeFi, of course, a much clearer path with how they come into kind of compliance and why they should come into compliance under this infrastructure bill, why they should be considered brokers. But then you turn to DeFi. Within DeFi is many, many different verticals. And depending on the scenario within that DeFi, if you're talking about protocols, different entities and miners and just software equipment that is being utilized in the DeFi sector, it's not a one size fits all scenario. I think DeFi alone will need to be looked at for the different iterations of scenarios happening. I do think some of the DeFi activity is pretty similar to CeFi. So there is some kind of like clear off the top that you can take out and be like, this aligns more with CeFi. But then, I mean, it is a black hole you can go down of different activity that's occurring. And so it gets much, much more difficult, like Rob hit on of how do you truly know who is on either side of the transaction? And are there multiple quote unquote parties in between those two sides of the transaction? And so it gets to be a much more difficult conversation.
Totally. I mean, you have to really look at how the transactions are enabled technologically and what are the roles of each party to those transactions, right? So we get into both, the technology and also the legalese.
Yes.
And you have to look at both sides. If those two things don't line up, then you have to question each one and then go a level deeper. This is what we do anyway, right? You want to make sure that they comport. Be very clear as to if you are in some role of a transaction flow, then really examine tightly how you fit into the explicit codified definitions that we just have, and then as the Treasury regulations come to be, like where you fit in your role explicitly. And if it's a little bit gray, maybe optically to a user or a regulator, time to clarify what that is, and use a little self-help and make it less subject to interpretation. In legalese, let's make it clear, right? This technology it's difficult to get your head around, and it's changing every day. And so let's be clear about what the technology is doing. Let's be clear explicitly how you're representing yourself in those roles, so that you some self-help to eliminate the ambiguity. Because I agree with you 100%, Erin. We have such a wide range of how these things are enabled. Just like make it clear to the extent you can.
Yeah.
No, I think that's right. I think that's what the direction folks are going to need to do. And I imagine that you all will be getting some phone calls as people try to figure it out. Them not even knowing, what does it look like? Where do I fall here? What are my responsibilities? Kind of want to get into a little bit of the reporting and like what some of that's actually going to look like, what some of the operational aspects of that are. And so just to kind of level set, what's the information now today, current, absent the rule kind of being effective, what's typically reported to taxpayers by someone, and we'll just stick with the folks that would clearly be brokers, right? And we'll stick to just kind of the exchanges and things like that that are definitely going to fall within that tradition, fall in that definition. What do they report to the folks that are doing things on their exchanges now? Is that something that where there is any reporting? Is that something you have to request? What's just kind of the typical?
I can jump in. So I think looking at what do brokers, you all know what you get from your broker right now. Let's take it outside of the, the digital asset space. The whole point of the infrastructure bill and the impending, regulations from Treasury, it is bringing crypto into the traditional financial world of broker reporting. So I think we've all received a 1099B or some sort of equivalent from our, brokerage firm. It would literally be bringing digital assets, crypto into that same scenario. And so you'd be getting your 1099B, with all the details, depending on your, trading activity, proceeds, cost basis, and the why is the same situation that there is now within the brokerage, traditional equity sector, of then using that upstream to prepare, your Form 8949, putting it on your Schedule D. So it's just, to me, it's bringing it all in traditional financial scope. And so the impact, though, it's not as easy as that sounds. Like everyone thinks, okay, we'll just send out 1099s. The problem is operationally what that means for these exchanges, and protocols, if they're brought into scope. It is a much bigger discussion, which I think we're going to touch on. But to me, that's really the question of what do you have to do now to even consider coming into compliance for 1099 reporting if you are swept under the broker rules?
Well, the operational considerations are vast when you get into it, and it's a lot of collaboration, I think, between the company and how the systems are designed. It's the software tools that enable you to produce 1099s. But I mean, some of the common topics are, valuation. What do you use, to put on a 1099 to report the proceeds? And, there's been a little clarity made in the last revenue ruling out there that says, gosh, if you have a popularly traded digital asset, using an aggregator tool to find value and dictate that for tax is great. Remember that that's not exactly the rule for GAAP. And not to profess what the GAAP answer is, but you may have to look to your principal market to determine valuation there, which may be a different number. Weird, but be aware of that as you design your systems. So valuation comes up a lot. I mean, you mentioned cost basis reporting. We don't have clear guidance yet on how to make sure that you're respecting, which digital asset, if you're an OG and you have, $100 basis and $10,000 basis and then $60,000 basis Bitcoin, and you all hold those, in one particular place, and you're choosing to transact using one of them and exchange one for something else, how do you know which one you're using? Do you have, clarity, the taxpayer's relationship with the custodian of the exchange, such that they know what to put as basis on the 1099 when they report the transfer? Because you're going to get to a very different answer depending upon which one you choose. So that's a big deal. There's also the question of cutoff. I mean, we all know this, right? Crypto doesn't sleep. It's sort of 24/7. It's all the time. So what time zone, what cutoff are you respecting? Let's make sure we're all clear. And again, you got to be respectful of the GAAP rules in your financial statements, but also then how that will be interpreted with the tax lens. So lots of operational considerations there then that come to those who facilitate digital asset transactions, those software providers, which are then enabling the reporting, and importantly, establishing a relationship with the taxpayer and the broker, such that their preferences are known about their basis tracking methodologies. And we have some methods allowed in the U.S. There are others around the world. So there's a lot of operational considerations and a lot of opportunity. Right, this is the time to engage and get it right. Be thoughtful about it.
Yeah. Let me ask you guys this, because this is one thing I've always wondered when it comes to this reporting, like ever since, I've been involved with crypto for a little while. I'm more of a buy and hold guy, so I don't have these issues quite as much as some others. But there's lots of transactions that are flowing, transactions that happen, on exchanges, off exchanges, and quite often there are transactions where you might acquire the coin from one place and then have it custodied somewhere else.
Yep.
You sell it, that's your taxable event. How do you bring all that together when, all the information in terms of, what the basis is, really to judge the transaction by, to see if it's even taxable or, what the liability would be, is not in one place.
Mm-hmm. Yeah. So I would say, again, looking at bringing all of the crypto into the traditional broker world. So the whole transfer statement concept, right? If you're an entity that is facilitating this type of trading with respect to whatever cryptocurrency that is, well, then you have to actually facilitate that movement of the basis, make sure it follows the asset wherever that individual is electing to trade. So if I'm going from exchange to exchange, maybe to wallet, back to the exchange, where, to truly come into compliance, you're going to have to, if you're an entity acting in this space, you're going to have to facilitate that movement of knowledge of that original basis. And so, and that's, again, we don't have clarity what that looks like. We know what it looks like for traditional brokers, but, due to the fact that there is no market cutoff, it's funny you said that, Rob, in talking to traditional financial entities that are thinking about that, they're like, oh, well, okay, so the market hours are X to X. And we're like, there's no market hours. It's 24 hours a day,
right.
And the speed at which this activity can happen is just, it's instantaneous. Yeah. So how can a transfer statement be even produced at the speed at which the movement is happening? So again, I think these are all due to the nature of how cryptocurrency is so different at its core. I think that there needs to be innovation just for the actual regulatory requirements that are imposed upon these exchanges. Mm-hmm. It can't be a paper statement that comes 2 weeks later. There was probably 300 transactions that happened within that time frame.
Mm-hmm. Yeah, absolutely.
The transfer statements, and yes, we know this is administrative burden. This is going to be difficult on a lot of people, but again, the net benefit is excellent, because otherwise, you're placing the burden on the taxpayer. Going to your example, Quincy, you buy a digital asset and you buy it, direct, because you're really tech savvy and you can do that, and it sits on your hardware wallet, right? And you buy it from a decentralized exchange, and then you want to move it to a particular custodian, and then they're going to gather that information, exactly to your point, Erin, right? You're going to represent your basis. They're going to transfer it to another custodian. It may be hop 4 or 5 times. And so, but what you're doing is you're tightening up the reporting such that you have a clear path of when it moved to a different location, but was still yours, versus it moved and resulted in a de facto transaction, right? And so I think there's as many protections against a bad answer being recast as a taxable event versus just a transfer of your stuff to a different location, which does happen a lot. So I think there's 2 sides of this. And again, with the clarity, with the required reporting of the transfers, exactly as you've said, Erin, I love that you keep making the parallels back to the TradFi world, right? And where we're at with traditional securities and commodities, which all those are there for those reasons. And so, crypto becoming a little more normal is a good thing.
Yeah.
I think that's right. And just kind of, drilling down on this a little bit more, understanding that we don't quite have all the answers quite yet, but my thought process, is, and I'm wondering if, the technology exists today, if it's something that can be done where, when you look at kind of the traditional, financial system and institutions, you have things like the travel rule where the information flows from institution to institution. And it's almost always the case that your assets, your funds, what have you, are going to travel from institution to institution. But, as you all know, I might buy my crypto and it goes to my personal wallet, cold storage. And then I take that and I, decide I do want to have a custodian hold it. And so I move to a hot wallet. Is there something where the information can travel from the point at which you buy it to the cold storage, and then that information travels from cold storage, back to, a hot wallet where somebody, has custody?
To
Are we
me,
there
this
yet?
to me, this is where the opportunity comes in for new business opportunities. I've heard things such as, should there be a smart contract that, attaches to that asset originally and travel with it? All different kinds of ideas, but I think this is where we're going to see a lot of innovation that we don't even know can exist yet.
Yeah, I think that's right. Rob, do you have any thoughts?
No, I mean, it is one of the bigger questions, I think, that's going to come through the regs, and that is if it's procured sort of outside of the visibility of a broker, then what happens when you subsequently transfer it to one? We know that you've got the broker has to report, right? That's the 60/50 rule. If it's more than $10,000, they need to put it on the form. What happens to the basis? Who knows? I think we'll probably start with some lessons learned from the old world, where you need to self-report, and then maybe that does place the burden back on the taxpayer. So keep your books and records, as always, is the advice that I would provide. We shouldn't rely on other parties to just solve everything for us. We need to take a little responsibility ourselves. And I love that you mentioned smart contracts, Erin, right? We're not done evolving. We're tightening things up a lot in the world of digital assets and financial products, which is super fun.
Mm-hmm.
Yeah, no, I think that's great. I think it's one of the things to me that's the most exciting about the digital asset space, is that there's so much more to come. I mean, I talk to my family about, digital assets from time to time. And when they ask me, well, like all this stuff seems like it's taken off, the way I explain it to them, I'm like, we are in AOL dial-up of digital assets right now.
Yes.
And we have so much further to go before we really know what all the potential is. And, I think all of it kind of building off of blockchain technology almost makes, some of the innovation limitless. And so, I think you all are absolutely right where, this is where innovation comes. I think innovation comes from situations in which there's a problem and you need a solution, and somebody innovates to come up with that solution. So I imagine that we'll be seeing something soon. And at the rate of innovation in the crypto world, I can't imagine that it will take too long. But if now I kind of want to switch to, if I'm a broker, these new requirements are coming. What do I need to be thinking about? What do I need to be doing? Because obviously the Treasury hasn't put the rules out yet, but they're coming. The legislation indicates that, everything should be implemented by 2023.
Yep.
What do I need to be thinking about? How do I need to be preparing myself and my company, to be able to comply? Erin, I'll start with you.
Okay. So let's just take it in the traditional CFI scenario, because I think that's a lot cleaner and easy to digest. And I don't think there's a lot of ambiguity in whether they'll fall into the definition of broker. So first and foremost, don't jump to point 10, which is actually issuing the 1099s. Let's back all the way up and look at, what do you even need to report on a 1099? Do you have the information today to do that? I think looking at your operations at the point of onboarding, how do you onboard new account holders at your exchange? What information are you collecting? Totally understand the ease that's needed to onboard within the crypto, industry, but also balancing that against what are the tax requirements from a 1099 perspective. So I think overall focusing on processes and procedures at onboarding, and then the technology you're internally utilizing to capture all that information, right? If you have like the best onboarding procedures, you ask every question, well, if you're not actually capturing that information, what good is it? So looking at it holistically of what do I need to change now, process-wise and product-wise internally, so that I can actually produce a Form 1099 when that comes about. And one of I think the overall biggest changes is this whole certified taxpayer ID situation. So if you are a broker, you're required to collect a certified TIN. You can't just call me up and I tell you my tax ID over the phone, you stick it in your computer system and you're good to go. It's a little bit more rigorous, not too much different. You're collecting the same information overall. You just have to collect it under penalties of perjury, which is commonly known as that Form W-9 that you are probably being asked to fill out at, your traditional brokerage firm already. So that's where I would really focus, is on processes and procedures right now.
Yeah, 100%. This is absolutely the place to start. And when you're looking at onboarding, there's another onboarding, which is like the broader regulatory concerns when you're onboard customers. So KYC, AML, it's not just about tax, and there's also OFAC requirements in there. So it's most graceful for those that are tax focused to be teaming with the broader regulatory group to make sure that your onboarding captures everything at one time. Let's make it graceful for the user. Let's capture it one time versus doing the different forms. Yep. The 10 is absolutely required. You want to make sure you nail that down, and we want to be compliant anyway, right? These are the rules, but the risk if you don't get the right information is that the backup withholding with at today's rates, I think it's 24%, and that's on gross, and that sticks to the broker. So if you are otherwise required to capture this information and you don't, not just the penalties for not putting it on a 1099 later, but being stuck with backup withholding, 24% of the gross proceeds going across can be significant, and that usually gets the attention. Clearly, we want to be compliant anyway. But boy, when you start running the math on the backup withholding, these get to be big numbers given the velocity, which Erin referenced. I would also, in readiness, which you absolutely should start today, there's a lot to do, in my opinion, to get ready for this. Don't discount the complexities of all the different basis reporting scenarios. You're absolutely going to have preferences among your customer base. You're going to have to educate them on how your custody solution, how your exchange service allows them to choose or not which digital asset they are referencing in the instant transaction. What is the basis associated with it? How does that then port to what is being reported on a form? The complexities there are vast because there are different tax accounting methods which are available to different taxpayers, and there's an even broader range of what people think is appropriate. So you want to make sure that there's an education, like what's allowed, what's not allowed, but you're going to have people that want to take different positions. So how do you deal with that? How do you wrestle with it? How do you allow those preferences to be built in a way that is appropriate for your customers, the taxpayers, but also the brokers a little bit in the soup on this, right? You want to make sure that you are engaging with the rules, not just on the reporting of the proceeds, but also putting basis out there so that you're doing everything you can to facilitate compliance on the transactions broadly.
Yeah. Yeah, the customer services aspect, I think, is a huge consideration. Something we're hearing is, we don't want to ask all that information up front. It's going to stifle new account holders. But I think, again, the volatility with crypto and the speed at which you need to potentially execute a trade, if you put it in place on the latter side, you allow them to sign up, and once they want to trade, you hit them up with that trigger to give all the information, they could potentially lose out on the trade, and the expected benefit of that trade. And then Rob, touching on your point, I think the differences in allowable accounting methods from the taxpayer side compared to the exchange actually establishing that accounting method so they can actually facilitate that cost basis accurately is going to be really tricky.
We're coming up on time. This has been a really great conversation. One of the things that I think a lot of people are thinking about in terms of now there's this new reporting requirement. I think more people now actually understand what, tax obligations exist. If they didn't understand them before, they certainly know that they're there now. And so, as we're looking at this reporting, and, we're going to see reporting go into the IRS, we're going to see reporting go into the taxpayers. If there is some mistake within the reporting, does that fall upon the taxpayer? Does that fall upon the broker? What happens in that instance where I'm saying, hey, I went to my exchange, gave me this, I filed based on this. And now like the IRS is like, well, actually, we figured out that wasn't quite right. And so you owe us X with a penalty on top. Like what, how does that get adjudicated?
Yeah. Do you want to go?
It's a great question. I think, Quincy, and not an uncommon one. I think it really is going to depend on the facts and circumstances. If there's an error made or a misunderstanding made by a broker, do they have the ability to fix it? Sure, they do. Hard to do, and there's different ways to fix things that need to be fixed. I think at the end of the day, this is why you need to keep, as a taxpayer, you need to keep really good books and records, because the burden ultimately falls to you. And if there's a discrepancy or a misunderstanding, then you want to keep the backup such that you can support what you did, the positions that you took, the intentions behind it, as to the best of your ability, and keep that on a real-time basis versus coming back and trying to find it later. But I think, you talked about early days of the industry. 100% agree with you. We're also in very early days of tax controversy and how this plays out. A lot of different transaction types, a lot of confusion as to what things represent. And that's why just making sure that you absolutely keep all of your books and records to the best of your ability, because it's far from perfect. It's not going to be dialed up for a long time. I don't know, Erin, if you have any other perspective.
Yeah. I was just going to say the whole discrepancy of account holder saying something's wrong and the exchange actually, whether or not they made a mistake is always up to interpretation, and it boils down to the facts and circumstances every single time. So yes, 100% agree. Keep your own records, because of course there can be, there can be technological issues. There can be human error, but there can also be the scenario where there's just a difference of opinion. And it's not a true error or, something that triggers a correction. It's just every situation is different. So I would say not only really accurate and clean ability on the taxpayer to keep those records, but on the exchange side too. Having that detailed information available and accessible when there are questions that arise is just as important.
Absolutely. I had about 15 more questions, but we've run out. I mean, that's how, I guess, I'm one of a few that really gets into this and wants to be into the nitty gritty, but I'm sure there's a lot more out there that are really grateful for the conversation that we've had today. Erin, Rob, I thank you greatly. I think, a lot of people have been able to gain some insight in terms of what's coming. And I know whether it be TaxBit or whether it be and Deloitte Tax, you all are crafting some of the solutions that will hopefully make it for folks like me that are the end users easy and seamless to go through this. Really appreciate it, and we will sign off and say good luck to everybody. We're looking forward to seeing these Treasury regs, and we're going to be off and running here really quickly.
Yeah. Thank you so much, Quincy. It was really enjoyable.
Yeah, great conversation. Thanks, Erin. Thanks, Quincy. Thanks, everybody.
Thanks.
Good luck.
Bye-bye.
Bye.